what's up, everybody? It is Wednesday, September 28th. I'm going to try to explain what happened today, really over the past couple of days. I'm going to try to explain this slowly and calmly and rationally, but I don't know if I can because it makes me so mad I want to blow! I don't know how many times or for how long I've been trying to explain to you guys that we are in the grips of a schizophrenic, psychotic, environment where there has become embraced, ingrained, like with a lock and a key, this single variable failed approach to regulating the economy, which is the scourge and the disease of monetarism. Sickness, psychosis, schizophrenia, delusion. And if today is not a clear example of that, then I don't know what is. Let me try to break it down. And believe me, I don't even want to break this down. I'm going to do it hopefully for your benefit. But this is like trying to explain what happened today is like trying to explain the behavior of a schizophrenic, psychotic, insane madman. It's not really worth it. The behavior is irrational and it's crazy. And, trying to explain it is not very constructive. But the reason I'm going to try to do it, and I don't even know if I could do a good job because I'm angry. I don't even know if I could do a good job because, I just see it as some kind of absolutely insane, crazy behavior, and trying to, put it in a way that seems rational, it's almost impossible. All right, so backstory is, central banks have been raising rates. This is the failed single variable policy that has been in place for 30, 40, 50 years at the exclusion of everything else. And we know that investors, economists, the media, everybody worships at the altar of monetarism, despite the fact that it has been shown to be an absolute failure. They keep doing it and doing it. Einstein's definition of insanity. So the other day, when was it? UK, Liz Truss and her Chancellor of the Exchequer came out with a fiscal policy plan. And there's been some criticism of that, maybe rightly so, that it's another one of these trickle-down economics, BS. But in any case, it was an attempt, or it is an attempt, to try to stimulate economic activity through very large tax cuts, increased government spending. You know the whole thing. I explained it to you here. And instantly, there was a wild and hyperbolic negative reaction in the financial markets about, oh my God, this is hyperinflationary. We're going to crash the pound. Interest rates started skyrocketing in the UK. Bond yields started to go way up. Now, mind you, the rise in bond yields was not just like a sudden phenomenon because of the fiscal plan that Truss, put forward. I mean, they've been raising rates, all this year, just like the Fed. All the central banks, with the exception of the Bank of Japan, the Bank of Turkey, which is cutting rates, they're the only ones that haven't been raising rates. So again, the monetarist craze took hold. They crashed the British pound. They smashed the markets down. Bond yields went sky high. Even in the U.S., okay, we approached 4% on the 10-year. And now it turns out that today, because it appears that the Bank of England started to kind of lose control of the policy rate and also where they want the yield curve to be, you know, the longer term, and they reacted. They reacted by saying, we're going to start buying bonds again. And that's their job. That's their function. If they set a policy rate, okay, they want to sustain that rate. There's a reason, at least in their minds. And again, this rate hike BS, this does not squash inflation. Okay, that's a whole other video I can make on that, but I've said it so many times, you know, the cost of credit, and we see it, the cost of credit is going up, housing is more expensive, you know, across the board, food costs are more expensive, your monthly debt service payments are more expensive. It just raises the general price level. But anyway, that's the orthodoxy, that's the insane, you know, because that's Einstein's definition of insanity. If it doesn't work, I mean, we have examples all over the place in Turkey and Argentina and Brazil, all over the place, right in front of their freaking eyes, you know, with the rate hikes. And then you got Japan that doesn't raise rates, and it's like practically no inflation there, even though they're a major importer of oil, okay? But no, they don't want to consider all that stuff. They don't want to look at that stuff. So anyway, so today what happens? They said, Bank of England says it's going to start to buy bonds, and, you know, it has to do that if it wants to maintain its policy rate. You know, it's going to have to do that. Otherwise, it literally cedes the policy rate to the market, and central banks don't like that. They want to be in control, even though they think they want to be in control, but they generally just do whatever the talking heads say they should do, and they do whatever the market price is in. Bank of Japan doesn't. So, and I should say that there's a sidebar story to this, that it appears, and I was told and I read, that pension funds in the UK, some pension funds, I don't know if it was a broad-based thing or if it was a few pension funds or whatever. There was some stories out today that these pension funds were in trouble. They were getting hit by massive margin calls because apparently, and I looked into this and somebody explained it to me, and again, I don't even feel like talking about this stuff. I don't even feel like explaining it, because it's like trying to explain the behavior of a raving lunatic. It just is not constructive. But anyway, so apparently these pension funds, because rates had been low for so long, you know, up until recently, trying to, gain extra yield, extra alpha, as we call it in the investment game, they entered into all these derivative transactions to kind of leverage up. You know, pension funds are only supposed to hold bonds like cash bonds, right? I mean, they're fiduciaries. They have a fiduciary responsibility. They're not supposed to be speculators or highly leveraged. But anyway, from what I was told, they entered into these derivative positions that gave them some extra alpha, some extra return on that position. And now with the Bank of England jacking up rates, they were hit with margin calls, all right? And supposedly there was something broke in the market, all right, for lack of a better term. I don't know. So the Bank of England was forced to step in and calm things down by doing what it's supposed to do. If it wants to maintain a policy rate, that's what it has to do. And again, understand that all this was put in motion by the central banks who think they're going to squash inflation by raising interest rates. So now when that happened, and by the way, let me backtrack a second, and I'll remind you that when the Bank of England said it was going to raise interest rates as much and as far as it needs to protect the pound, which in fact is bearish for the pound. Because remember, Turkey raising interest rates, what happened to the lira? Argentina raising interest rates now 75%. What happens to the peso? It goes down. So, and when they said that, what happened to the pound? It crashed even further. So now today, they're back in there, and the news goes out. QE is back. Quantitative easing is back. So here's the minds of investors. You know, they were in this terminal state of fear. Remember, terminal meaning death, like interest rates equal death. Interest rate hikes equal death. Terminal, I've been using that word. And all of a sudden, because the Bank of England stepped in today and said they were going to be buying bonds, they didn't say they were going to stop raising interest rates. This is another crazy irrationality. How can you be raising interest rates and doing QE at the same time? They didn't say they were going to stop raising interest rates. You get the picture how convoluted and crazy and ridiculous this is. So anyway, what happened was the market started to react like, oh, they're going to start cutting interest rates. We had a 25 basis point drop in the U.S. 10-year yield. All right? Right away, this mentality that has been in place now since the beginning of the year, since March, of terminal interest rate hikes, terminal equating to death, in the minds of investors, that went right out the window today. Just went right out of their heads. And now, hey, we're back to QE. Nobody said anything. The Fed didn't say it was going to stop raising interest rates. As a matter of fact, a couple of Fed officials were out today saying, hey, yeah, we're still going to like 4.5% by the end of the year. The Bank of England never said it was going to stop raising interest rates. And again, I don't think... like I've been saying, none of this matters in the long term. None of this interest rate BS garbage, none of this matters in the long term. None of this matters. But this is the psychosis, this is the insanity that has a grip on everybody. Everybody. It's insane. And so now, of course, because why have they been selling the market down? They've been selling the market down, as I've been telling you, not based on economic data. I mean, we had really strong payrolls in July. We had strong payrolls in August. We have very low weekly unemployment claims. We see the numbers coming in now on consumer confidence. We see the numbers coming in now on new orders. We see the numbers on retail sales. I mean, you know, so... the stuff that matters, the economic growth, because growth equates to profits. Profits are what drive stocks. It's not even that that's not being paid any attention. It's like, if it's good, we got to sell the market because that means rates. If everything is construed as rates going up. Terminal view of interest rates. Terminal meaning death. It's the end. Like if you have a terminal disease, terminal cancer or something like that. But today that went at it, all was gone out of their heads. All was gone out of their heads. So, I mean, I don't know. What do you think? This is the behavior of a madman. And if you turn on the TV today, probably you saw mostly coverage of the storm, Hurricane Ian down in Florida. And boy, I don't know, I hope you don't live in Fort Myers or Naples or Cape Coral or one of those places there, because, I mean, I saw the storm surge was up to the second floor on some of these condos, and cars were completely submerged, like the Gulf of Mexico. This is not just like a flood. This is the Gulf of Mexico, the ocean coming in. But if you happen to catch any of and I don't watch any of the shows like Fox Business or CNBC, but as I was, changing channels to catch the news on the hurricane, I did pass by CNBC, and of course, what are they talking about? The Fed and interest rate, the Fed, that's all they ever talk about. That's all they ever talk about. I mean, folks, it's a sickness. I mean, you have a whole entire industry and everything associated with that glued to this single variable failure of a policy that, it permeates through everything. How do you expect people not to be nuts, crazy? I mean, it's like an indoctrination into a dogma or a belief system that is absolutely 100% delusional. And in an instant, it can change one way or another, regardless of what the true underlying fundamentals are. The fact remains that, and I give you the numbers. I am here every day giving you the numbers. The interest rate so far, which is just really starting, we're starting to see the fiscal flow benefit from this. 40 billion already this year just from the T-bill discount. A 20 billion surge in interest on treasuries, and like I say practically every video, that's just getting going. It supports demand. It flows to income through that interest channel. That supports demand. Like I said yesterday, there's no evidence of a decline in demand. Speaking of demand, we saw the EIA weekly petroleum status report today. Very strong exports, strong gasoline, very, very strong jet fuel demand, strong distillate demand. I mean, across the board, and it was a drawdown in crude inventories, even though we had another almost 5 million release from the SPR. Folks, this is bizarro land. This is wacko land. It's wacko land. The good news is, and let me mention something that does matter, okay? We finally got a positive fiscal flow yesterday of 10 billion, whoopee. So, that takes the net drain for September down to 144 billion from 154 billion. Still got a long way to go. Friday's going to be a good day, Friday, Monday, because we're going to get a 64, 65 billion net positive flow. So that's going to, I don't know what today's number is going to look like. We'll see that tomorrow. I don't know what Thursday's number is going to look like, but I'm telling you that Friday's going to be a positive flow, and that should take us down somewhere around, and I got to check when the Social Security payment, I forgot to look at that, when the payments are. If there's one more this month, I don't think so. They're coming in October, the next round. So it should take us down by Friday, to like 80 billion drain. There's still a long way to go. We got to make all that back and then add to it. And like I said yesterday, we still have the potential for a government shutdown on Friday night. It's not going to affect the flows on Friday. Those are going to go out, at the crack of dawn. But Friday night, if Congress doesn't, come up with a continuing resolution, we're going to have a government shutdown. And that, like I said yesterday, it's the last thing we need right now. Although I will say this. If this terminal fear about rising rates has gone away, because of what happened today, and then I think the stock market can see a pretty significant rally, because all of this short position, all of this selling, okay, all of it is from rate fears. All of it, everything, the embedded short position, the sales, the people moving to cash, the fear, the heightened level of fear. It's all 100% due to rate fears. So if that goes away, or if there's a moderation in that, if there's a feeling like, oh, this is going to cause the Fed to pivot, then all of this is going to be unwound. Unwound. I mean, even if there's no fiscal flow that is supportive, or if it takes a long time, all that short. You know, I get a kick out of all these posts that I see and news stories about how, you know, the people have lost, the public, the economy lost $9 trillion in wealth. No, it didn't. You know, stocks maybe went down by that magnitude, okay? But it just means that people moved $9 trillion from stocks to cash. And there's like they're sitting on $9 trillion of cash. They have, look, when the price of a financial asset changes, it does not change the aggregate amount of wealth in the economy, okay? That does not change. Now, your personal financial position might well have gone down. It's like the fallacy of composition. It's like the same argument, which is a wrong and erroneous argument when you say, like, in order for the country to have more savings, everybody has to save. No, if everybody saves, we have less saving. If I save, remember, then the movie theater owner and the restaurant owner and the supermarket company, they get less of my income, their savings go down. So I might have more, but now they have less. You can't do it that way. It can be true for an individual, but not in the aggregate. And the same thing with this wealth effect. There is no wealth effect in the aggregate for a change in asset prices. What happens is you got less of one asset and more of another asset. So people are sitting on less stocks now and more cash. All right? It's the same thing like when real estate prices go up. It's great for homeowners, but people who don't own a home, who want to, they essentially become poorer. Okay? They can't afford it. When home prices go down, then yeah, the homeowner feels it, their net worth goes down. But now somebody can afford it. It's the same thing. It's functionally the same thing as them having an increase in their net worth. You got to understand that. Like, I see all these things like, oh, it's lost $9 trillion. The economy, it didn't lose anything. It just switched from securities to cash. The cash is still there. Everything is still there. They're just being held in different quantities. That's all. So if you make the mistake of equating your own personal situation to the macro, you're making a mistake. That's called fallacy of composition. Anyway, like I said, I didn't even want to do this explanation. I don't even know how good this explanation is, because I just, again, I'm not good at trying to analyze or explain the behavior of insane, behavior. Maybe it's something interesting for a psychologist. For me, it's a waste of time. It is a waste of time. I am telling you, all these things that people are so freaked out about, Fed and monetary policy, and what's the Fed going to do, and the Fed this and the Fed that, and the Bank of England, it's irrelevant. At least in the way they think about it. There's some relevance to it, like the way, I explained how it works, but nobody sees it like that. Nobody. Anyway, that's it for today. Don't forget, go to my website, pitbulleconomics.com. The link is here. Sign up for a 30-day free trial of MMT Trader. Don't miss out. Go do it right now. Bye.